Good morning, ladies and gentlemen. Well, the higher real rates and term premium show continues. So I don't really have that much new to tell you because everything is going the way I think it will continue to go. We've made a new high. It's not updated here, but we are in the 234, 235 area in the 10-year reals. And, this chart does not look good. It doesn't look to me like it can stop before the 250, 255 area, take a bit of a breather, and then continue higher and make new highs for this move up. That's why I've entitled this week's video as CPI had better cooperate. Because if it doesn't, we're going to go and do this very fast indeed. Bonds always end a move by spiking, and that is indeed what I expect is going to happen. This is TIP, and as you can see, I don't think there's any reason to expect it to stop until it tries much lower. But what is interesting is that TIP's Z with that's the Pinko one, which is slightly more duration, is looking even more bearish, and LTPZ, which is the longest duration tip that I know, 15 years plus, is about to revisit its lows. This 49.86 is the lowest close, and eventually, and I don't mean next week, I mean eventually, I expect it to make new lows. New lows would be the lowest it's ever traded, because when it started in 2010, this was the lowest. I don't think that has any significance by itself, but I think that that would be an interesting area to go and look at this, 48 or even a little bit lower. And everything is telling me that that 275 area in 10s reals and probably just above 3% in 30s reals is going to be where we end up. In the meantime, this kind of behavior by the market is pressing equities. In fact, they're doing reasonably well given what the bond market is doing. Let's have a look at where the individual 10-years and the yield curve says that we might be going to. Let's have a look at what the yield curve did on Friday after NFP. It was the fives, the intermediates, that really got shat upon. And what does that mean? Well, that basically means that the market is not seeing any move from the Fed for quite some time. And here we have 2s10s, which basically did nothing. They just bounced off the minus 42 big support. And I'll just remind you how big a support that is, going all the way back to 2020. It's a watershed level, right? But let's have a look at something like 5s10s or 5s30s. And here's 5s10s. You can see how significant that move was. And if we have a look at 5s30s, much more significant too. Now, I don't think it's going to go a million miles. I think if we get back to this 30 level, I would like to get longer 5s and shorter 30s again. But what it tells you is that when the curve pivots around the 5s and the 2s, let's have a look. And you can see here the 2s went up 11 basis points, the 5s went up 13 basis points, and the long end went up, between 4 and 2 basis points. It just means that all the pressure was around the 5s. The 2s naturally went up as well. And let's have a look at the individual 10-years. I don't think that 442 is going to hold it. I just don't. If the CPI is bad, let's say hot, I think we go straight to 456. Now, you pay me for my experience, and I can tell you that I was buying a long time ago, but I was trading 2s at 100 over Fed funds and getting buried. When the market gets into this kind of mood, it doesn't really matter if it's 20 or 30 basis points above funds and you can just hold it. No, it doesn't work like that. The market can easily go to 455 on a bad CPI number. And can it go to 475? Absolutely. Because the market is going to start pricing in a very steep yield curve. Where can fives go? Well, they're so close to their previous highs. I think any kind of a bad CPI, and we're trading 474, 475 before you can bat an eyelid. Tens, less so. I think 10s and 30s are going to be more forgiving on a hot CPI number than the very short end. I think 2s and 5s get absolutely smacked. I don't think that 10s are really going to go much above 490. And you saw the behavior of 30s when they got to 5%. They rallied, 6 basis points straight away. We will revisit that 5% level, and probably we will trade 504 or something like that. But I don't think that the action is going to be in the 30s. I don't think the market is in the mood now to say, oh, the Fed is fueling inflation. No, the Fed isn't fueling inflation. And there's so much further news than what the CPI was last month that we're going to get over the course of this year, that I think the 30s at that level are looking attractive relative to everything else. And that is why I keep on saying that if I see the 275 level real, I think it's a great buy for a very long time. Now, things might change later, but I don't think that we have enough information now to say that things have changed. What has changed? Not a lot, really. It's just that the market got far too long at far worse levels than we're trading, and people are dumping it and people are worried. That's perfectly normal, but I don't think the problem is going to be in the 30s above 5%. I think it's going to be all in the intermediates around 450. Why would you be that happy buying 450 in the intermediates if that's it? You're not going to get any more Fed cuts. You might at some stage get hikes. It all depends on what the economy does. It all depends on inflation. It depends on so many things. But how much safety do you have at 20 over funds? I mean, not a huge amount, right? So I think the market is going to price in some more safety, something around 470, and that will be all she wrote. But the mere fact that they're hitting the fives means to me that they are losing a little bit of hope that we are not in a period where the Fed can do much about anything. The Fed is going to be neutral here for quite some time until it gets some very clear data that it has to move in one direction or another. And when that happens, 10 basis points, 20 basis points above funds is not where the safety lies. The safety lies double that. And that is why I think that we are likely to reach these higher levels and reach these higher real levels, and that should be the level of safety. When even Schatz, which in theory should be the most bid contract, is behaving the way it's behaving, that tells me that the others are just not safe, right? So let's wait for the Schatz to top out before we can say that the bond moves are exhausted. Where is Schatz likely to top out? Well, I would have thought at these levels in the 240s. Now, whether it's 240 or 250, I really expect in the 240s for it to stop and actually have a return to 225. That makes perfect sense. I don't think the ECB is the one that's going to stop the cuts. I think they will continue. And if we get stops all the way up to this kind of level, 242 to 245, that is going to be a great place to buy the shats and probably sell something like 5-year US, but also a great place to look for the shats to come back down to 224 and look for the yield curve there to continue steepening. I don't think the problem is in the shats. I think at some stage here you catch it. The problem is going to be in the fives, because as you can see, the 2s 5s is only 9 basis points, and that probably is too low. This can go far further than the shats can, and the 10s, as you can see, the Bund has broken above 252. I think that indicates to me that even the Bund is going higher, and probably is going to something like 267. That really shows you that there is very little support for the bond market at these levels, and that you need a bigger margin of safety. The 10-year French, it's just a scary chart. This could go and make new highs quite easily and be dragging everything. And if you look at the way that these markets are trading, you get the Italy against Germany, which is beginning to turn. For the first time, it's done a higher low rather. It's a dangerous spread. You are picking up pennies in front of a steamroller if you hold the Italian and the French market, especially the French market. Look at that. I mean, to me, this is a really, really scary chart that says at some moment some political crisis breaks out and we are down in the 130s, 140s for a few days. Just don't buy them. I mean, it's to me as simple as that. Now, I know that we've got a potential bearish event on Monday in Japan, but I really don't see that it's going to be all that bearish. 120 in Japanese 10s, it's pretty good level. 5s at 80, God candle there. And the 2s, they keep on going up. And given that they keep on going up, I'd expect them to get to at least 75. That tells you that there is continuing pressure on all these bond markets, and that you don't want to buy them until you have a significant margin of safety. And that to me is not before 275 real. It's not before you have at least 25 basis points between Fed funds and 2s, and you can fund the stuff knowing that how likely is it that the economy really reaccelerates, or that inflation really reaccelerates. At this point, there isn't a huge amount of data that would support that view, and therefore there you have a margin of safety. Before that, I would steer clear. Why not just invest money at 430? Do you think there's going to be a quick move down in rates, in Fed funds? I don't think so. I don't think there's any reason for that to happen. So I'd much rather own a floating rate note at 430 than invest 2-year fixed, at 435, 440. Why would I do that? It makes no sense during a period where the US economy is proving to be stronger than anyone thought. And finally, I wanted to show you a chart of the biggest whipping boy in history, which is the gilt, 10-year gilt. This is a weekly chart, and I've done it weekly so I can go all the way back to 2000. It's never really traded above 580, and as you can see, it's made a new high on the move, indicating that there's worry. I think 533, if not 580, is the level that it's going to. I don't think it's going to break 533 in a hurry. but I do think it gets there. And given the fact that we are at 485, that gives you nearly another 50 basis points of move in the gilt. What does that tell me about the US? What does that tell me about Germany and France and Italy? It tells me that it's too early to buy. And if reals are trading at 435, 235 reals in the US, that tells me there's an above average chance that they get to the levels that I've been mentioning for such a long time, around the 275, where things get really, really interesting. And why would you not buy it? It's the same for this gilt chart. Why would you not buy it at this kind of level around the 533 or slightly higher? To me, there's very little chance that inflation in the UK diverges significantly from the developed markets average, and very little chance that the US economy becomes stronger than the US economy. So at that kind of level, I think you are looking to be an interested buyer of gilts as well, if nothing else on a diversification basis. I think it makes far more sense that you want to buy these levels than not. This is a chart of the gilt against the 10-year, and you can see all the way back to 2000, where was resistance always? Around 80 to 90 basis point, and then it always went to negative. So basically it's been trading, I would have thought, from minus 40 to plus 90. And it just shows you how much demand from diversifiers there will be at those levels. At the moment we're like at zero. So I think there's plenty of room for us to go up, but also once we've done that up, there's going to be plenty of room for us to come down. And that's why I think the gilt at those levels that I just showed you previously is going to be a very, very decent buy. The Dixie went further than I thought, and it continues to be a wrecking ball, and it continues to be bullish. I just can't buy it up here simply because I don't have enough information about the differentials going out again. In fact, the differentials, I haven't shown them to you, but you will see that the 2-year and the 10-year are, if anything, lower than they were when we were at 109.29 and backed off all the way to 108. So this was quite a significant backing off, but of course, as soon as we caught the moving average up, we went to 109.70 with the data that we had on Friday for NFP. Not really surprising. Friday was a thin day, probably a day after the holiday, and we went up. Now, I mean, am I ever going to short it when it looks like this? No, but I'm just not going to buy it. It's just not for me. I think the risk reward up here is not good to be long. We are very overbought on the weeklies as well as on the dailies. And what are we hoping for? Well, I guess anybody buying it here is hoping for this 112, 113, 114 level that we saw all the way back in the late part of 2022. I don't think we're in that kind of environment. I think, Trumpy would get absolutely extremely annoyed, let's say, if that were to happen, and would demand some action. Really don't think that we are in that environment. But what we are in an environment for, and this is now Euro Yen, to me it's beginning to make sense that every time, and I've told you this before, every time it goes anywhere near the 200-day moving average, which is just above 164, you are supposed to short this. The yen is the one that he will want lower. I don't think he'll particularly care where the euro is, and I know that Dixie is 65% euro. So that is why Dixie can stay bid, and I don't think he'd care that much. But against the yen, I think he does care. And that tells me that euro yen is becoming a very attractive proposition. Could it be doing a head and shoulders? Absolutely, but we won't know until we start breaking 154 and trading the 200 week moving average down here around the 147, 148. It might take a very, very long time, i.e. a year plus, to develop. But I think up here around the 164, I think it's far more likely to trade 155 than it is to trade back above the 167, 168 level. And that's why I think it's worthwhile trading 164 every time he gets there. And we know that we have a very important speech on Monday by the Japanese. Let's see what happens there. But I'm, a seller of euro yen every time it goes up. This might be the speech that actually pushes euro yen down. And if it starts going down, I think you want to jump all over it. I don't think it's going to stop before it hits this 155 level. What is gold doing? Well, basically it's going sideways, but during that sideways movement, it's allowing the 200-day moving average to catch up with it, and it's trading relatively well to all its peers. If you have a look at gold against TLT, it's just made a new high. If you have a look at gold against SPY, it's basically still in a range, but with a positive bias for the time being. And if you look at gold over GSG, it's doing a correction for the first time, but it's allowing the 200-day moving average to catch up with it. What does that tell me? It tells me that there is a lot of safety in gold at the moment, because if gold is doing better than TLT, and gold is also doing slightly better than SPY, I think there's a lot of safety in it into GSG. And if you look at this GSG chart, this 23 level becomes very important. And what is gold doing against GSG? As I just showed you, it's coming to the 200-day moving average. I would rather hold gold than GSG at this level, but all that tells me is that GSG is unlikely to break this 23 with any conviction. It's just likely to stay up here, and that will allow gold to make a new move later on. You still have to be a buyer of gold on dips. You just have to be, because it's doing nothing wrong. Every time it dips, there are buyers, and all it does is consolidate and is ready for the next move higher. I can't fault it. If I look at GLD over dip, it's still in a big long range since basically October, but it's not going down, and I expect dip to go down, but I expect gold to go down less. So at some stage, if I want to buy tip, why would I not buy gold as well? It just makes sense to me that gold has got very little downside at the moment, and I would rather own it than GSG. And if I would do that, then around here, I think gold is not a bad investment, simply because I think it's going to perform better than stocks, and I think it's going to perform better than bonds. So what can one say? It might not go up, and let's have another look. It might not go up outright, but I think that all dips are going to get caught by this 26.30 level in gold. It's really not going to go down much more than a couple of percent, while other asset classes could suffer more. Let's start with SPX on my clean chart. And for the first time, it's actually closed below 58.65. That tells me that we should trade 57.62 at some stage, probably before NFP. But I don't think that we stay there, and I just can't get short right here. I can buy some options, I can do that kind of stuff, but let's have a look at this chart, which is the 195-minute chart, and we can see that we are right on top of the 200-day. And can we do something like this? Absolutely, but I think that we will be very much where we are now when the CPI comes out. And the CPI will decide whether we can breathe a sigh of relief and probably trade up towards and close this gap at 59.13, or we go a hell of a lot lower than this, because after this level at 56.67, you know, this is where the really big support is from this whole area that we traded between, what is that, August, and then finally broke out of it in September, mid-September. So you have a quarter's worth of trading there, and that is really going to be the big level, 56.67. I expect a lot of support there. Everyone is looking for this gap here to get filled to buy. I think that's the wrong thing to look for. It all depends on CPI, but this to me is going to be the really important level. As long as we can hold 56.67, I am still looking for a bear flag, rather a bull flag eventually, right? I'm still looking for support. Only that kind of break would tell me that we are in imminent danger of doing something like 53.21. And that's not going to happen anytime soon. It's going to take a long time for that kind of thing to develop, which tells me that the risk reward is in buying puts on squeezes until Wednesday. And after Wednesday, all bets are off. We'll see what the CPI is. But if bonds can't hold after CPI, I don't think stocks can hold either. Stocks are going to do better than bonds on a higher CPI, but it just tells me that we are going to slowly start turning this 200-day moving average, and that all the bounces are going to be sells. Another reason why I'm not so happy being short at these levels right here and right now in SPX, and why I reduce my put spreads, is that I just don't see a lot of impulsiveness to the downside in the Nasdaq. And we all know that it's all about the Magnificent 10, and unless they start giving way, there's, you know, how much can those smaller stocks take the SPX down? So what is the level? 20,392, I mean 20,400, let's call it. And where is the 200-day, 200 period moving average on the 195-minute chart? Right there. Just gives me so much conviction that unless we can break this 2,400 level and close below it, SPX can't do that much worse. And therefore, only on a break of 20,400, which would allow a move to 19,004 over the course of a week or so, you know, not this week, but the week after, let's say, that would tell me that we are then more likely than not to trade the levels in XPX that I told you. So here we have one important level. I think that we can then go and fill this gap here, which would be the 19,300. So that there you have it. Unless 20,400 breaks in the Nasdaq, I don't think that we can go straight down. It'll all depend on CPI, and once CPI is out, if we see breaks of 20,400 in the Nasdaq, then I think that the SPX is pretty much cooked. One sign, and let's hope it's indeed a sign, would be if we started trading above 2060 in volatility. As you can see, vol hasn't really cooperated here. It has closed, quite a bit higher on the day and on the week, but I don't think it's yet ready to break out huge. But if it starts trading above 2060, I think it gets to 2280 in a big hurry. And that to me says that we will see that level that I mentioned. And let's have another look here, i.e. first 57.62 and then lower. And we trade something like this level, which is 56.68. I think that is definitely likely. If you see vol trading above 2060, I think it definitely trades 2280, and those levels are seen. I want to keep this brief because there's absolutely no point in telling you that we're getting things right and that we have to stick with it. Bonds is just too early to buy them. Not enough margin of safety. You've seen what my levels are. Before the 2-year gets to 455, I don't want to know about it. I don't think the 442 level would hold on a strong CPI number or even a slightly more than in line number. I think the market is in that kind of a mood that it basically takes yields higher and prices lower in bonds and then asks questions later. So I don't think that anything on the curve can stop before the twos get to 455. I am basically just not a buyer until I've seen the number. I think SPX stays around these levels and whips around until we see the number. But if that is bad, I think you really come down to these levels quite fast, especially if vol starts breaking 2060, as I put it there. Commodities, I'm really not a buyer until we have several weekly closes above 23 in GSG. And I think that is unlikely. I think oil has done all it's going to do for the time being. So I don't see the impulsion in GSG. But I do see the point that gold is making, that it's better than all the alternatives. And if that's the case, it's definitely going to be supported anywhere around the 2640, 2650 area. And there's very little downside in it. It will go down if bonds go up in yield and if the equities get hit quite hard. But it's going to trade better than all the alternatives, it seems to me. Thank you very much indeed, and tweet you tomorrow.